Let me start with a simple question. If $10,000 suddenly appeared in your bank account today, how long would it last? A month? A year? Forever? Be honest. Would you spend it immediately? Would you save it? Would you invest it? Or would it slowly disappear without you even realizing? Here's something important. Most people don't lose money because they don't earn enough. They lose money because they don't know how to manage it. And this isn't just true for individuals, it's true for companies. Even very large companies today, we're going to understand something fundamental. What financial management really is, and why it determines whether a person or a business survives or collapses. Financial management sounds complicated, but at its core, it's simple. It's the discipline of deciding where money goes, where money comes from, and what happens to it next. Those three decisions shape the future of every company on earth. When money has direction, it builds stability. When money has no direction, chaos follows. Let me show you something simple. Imagine you earn $2,000 per month. If you spend all $2,000 the moment it arrives, you survive today, but you slowly destroy tomorrow. No savings, no investments, no safety net. Now, imagine you manage that same $2,000 differently. You spend $1,500 on your needs, you save $300, you invest $200, same income, different decisions, completely different future. That difference is financial management. Now, let's step into the business world. Imagine you open a small coffee shop, you invest $50,000. You buy equipment, you rent a space, you hire staff. Now, every single day, money moves. Customers pay you, you pay salaries, you buy supplies, you pay rent. Everything looks active, everything looks alive. But here's the critical question. What happens? If you don't manage that flow properly, the answer surprises most people. Even a profitable coffee shop can go bankrupt. Yes, sales every day, customers lining up, money coming in, and still collapse. Not because it isn't earning, but because it isn't managing. This is why financial management matters. In every company, every financial decision falls into one of three categories. Miss one of them, and the system breaks. These are the three pillars of financial management: investment decisions, financing decisions, profit distribution decisions. Master these three, and you understand the foundation of corporate finance. Let's start with the first pillar: investment decisions. This answers one simple but powerful question: where should the company put its money? Imagine a company has millions available. It could build factories, develop new products, upgrade technology, expand into new markets. But it cannot do everything. It must choose. A good investment creates long-term growth. A bad investment destroys value. This applies to you too. If you pay to learn a valuable skill, that's an investment. If you spend money on something that gives no long-term return, that's consumption. Financial management teaches you the difference. Now, the second pillar, financing decisions. This answers a different question. Where does the money come from? Every company has two primary options: borrow money or raise money from investors. Imagine you need $100,000 to open a restaurant. You can take a bank loan, or you can bring in investors in exchange for ownership. If you borrow, you keep control, but you carry risk. If you bring investors, you share control, but you reduce personal financial pressure. Too much debt can destroy a company. Too little funding can prevent growth. Finding the balance, that is financial management. Now, the third pillar, profit distribution decisions. Let's say the company earns a profit. Now what? Should it distribute profits to owners or reinvest into the business? Reinvesting can accelerate growth. Distributing profits builds investor trust. Choosing the right balance matters. And this is where many companies fail. Let me show you how. Imagine a factory that stops maintaining its machines. Why? To reduce costs. Short-term profits increase. Reports look excellent. Investors celebrate. 6 months later, a machine breaks, then another. Production slows. Orders are delayed. Customers leave. Now, the company isn't just losing profit, it's losing reputation that short-term gain created. Long-term damage, good financial management prevents this. It protects tomorrow, not just today. Think of a company like a car. Money is the fuel. Financial management is the driver. Without fuel, the car goes nowhere. Without a driver, the car crashes. You need both. Profit provides fuel. Management provides direction. Now let's talk about the real goal. Financial management is not about making profit this year. It's about creating long-term value, stable value, growing value, the kind investors trust. Let me give you a simple comparison. Company. Banana earns huge profits this year, but it doesn't reinvest. It ignores technology. It doesn't develop employees. It focuses only on short-term results. Company Monkey earns moderate profit, but reinvests consistently, improves systems, develops people, upgrades technology. 10 years later, which company do investors trust? Not the one that looked impressive once. The one that built durability. Investors don't chase profit. They chase sustainability, and sustainability comes from strong financial management. Let me leave you with one final truth. Winning the lottery does not make someone wealthy forever. Managing money properly does. We've all heard stories of lottery winners who lost everything. The problem wasn't income, it was management. Money without management disappears. Money with management grows. Financial management controls how money is raised, how money is invested, how money is used, how money is protected. Without it, even profitable companies fail. With it, companies can grow for decades. Now, this leads to an important question. If financial management creates value, how do investors measure that value? How do they decide a company is worth $1 million or $100 billion? How does the market put a number on it? That answer lies in one powerful concept: market capitalization. And that's exactly what we're exploring in the next lesson.